If someone is self-employed and they've been turned down by a traditional bank, is their deal actually dead?
Not even close. The bank said no to how they look on paper. That's a documentation problem, not an income problem. Most self-employed buyers I work with have more money than the W-2 employees getting approved every day. They just need a lender who knows how to read their file correctly.
Before we get into the specifics, why is this conversation so important right now in this market?
Because the self-employed population is growing fast. More people than ever are running their own businesses, freelancing, consulting, and a lot of them are at exactly the stage in life where they want to buy a home or an investment property. And they keep running into the same wall. Traditional lenders look at their tax returns, see deductions that reduce their taxable income, and say, you don't make enough. But that's not the real picture. The tax return is optimized for taxes, not for mortgage qualification. These two are completely different documents serving two completely different purposes. The good news is there are loan programs specifically designed for this. And once you understand how they work, the path forward is usually very clear.
What's the biggest misconception self-employed buyers have about getting a mortgage?
That their tax return is the whole story. It's not. Self-employed people, business owners, consultants, freelancers, are taught to minimize taxable income, and they should. That's smart tax strategy. But then they go to a traditional mortgage lender, and that same smart tax strategy makes them look like they barely earn anything on paper. And the lender uses the tax return as the primary income document. So the buyer gets declined, and here's the thing the bank doesn't tell you. There are loan programs that don't use your tax return as the income documentation at all. Bank statement loans look at what actually flows through your accounts, your real economic income, not what's left after deductions. That single shift changes everything for most self-employed buyers.
How does a bank statement loan actually work? What does the lender look at?
Instead of tax returns, the lender reviews 12 to 24 months of personal or business bank statements. They look at the total deposits flowing in, your real gross revenue, and apply an expense factor to get your qualifying income. For a business owner with a personal account, we might use 100% of deposits. For a business account, we typically use 50% of deposits as income to account for business expenses. So if your business deposits $30,000 a month into a business account, the lender uses $15,000 as qualifying income, which annualizes to $180,000. Just a typical example. But that's a very different number than what we might show on a tax return after deduction. Credit score requirements are generally 680 or above for the best terms, and down payment is typically 10 to 20%. Rates are slightly higher than conventional, but for most self-employed buyers, the access to financing is worth far more than a quarter point on the rate.
Can you walk me through a real example of someone this worked for?
Absolutely. I had a client come to me, runs a successful consulting business, been at it for 8 years, earns great money. 2 lenders had already told him no. He was ready to give up on buying this year, but when I looked at his file, the problem was immediately obvious. His tax return showed only about $60,000 in net income after deductions, but his business bank statement showed over $200,000 flowing through the account every year. The banks were looking at the wrong number. We went to a bank statement loan, used 12 months of business deposits and applied the standard expense factor, arrived at $100,000 in qualifying income. Completely different picture. He purchased a $650,000 primary home, closed in 28 days. The 2 lenders who said no never asked about the bank statements. They just looked at the tax returns, said the income wasn't there, and they moved on. His income was absolutely there. It just wasn't on the page they were reading.
What do most self-employed buyers miss when they're trying to figure out if they can qualify?
Most self-employed borrowers assume their CPA's job and their lender's job are the same. They're not. Your CPA's job is to minimize your taxable income. Your lender's job is to prove your income is high enough to repay the loan. These 2 goals are in direct conflict if you're using the same documentation for both. The fix is simple. Get your CPA and your lender in the same conversation before you apply. Your CPA can tell you how your income flows and what documentation exists. Your lender can tell you which documents are most useful for qualification, and together they can often find a structure that works for both. The self-employed borrowers who have the smoothest mortgage experience are the ones who treat it as a team exercise, not a solo application.
What's the single biggest mistake self-employed buyers make in this process?
The biggest mistake self-employed borrowers make in this process is they're waiting until they find a property to figure out the financing. Every time. Self-employed income documentation takes time. If your tax returns don't work, we need to get bank statements together, run the analysis, and find the right program. I've had self-employed buyers come to me with a property under contract in 21 days to close, and sometimes we can make it work, but sometimes we can't. Not because the financing doesn't exist, but because we didn't have enough time to structure it correctly. The buyers who win are the ones who have this conversation well in advance before they start looking, not the week they find the house.
For someone watching who is self-employed and wants to buy, what do they do today?
For someone who's self-employed and watching and wants to buy, there's 3 things I would do today. First, pull 12 to 24 months of personal and business bank statements, wherever your cash flow is being generated. Know what your average monthly deposit looks like, and that number is the starting point for figuring out what you qualify for. Second, call your CPA and ask specifically, how does my income look to a mortgage lender? It's a different question than how it looks to the IRS. And third, call a lender who actually specializes in self-employed income, not a generalist. Someone who does bank statement loans regularly and can tell you within 15 minutes whether a pathway exists.
And if they want to talk to you specifically?
So if you want to talk to me specifically, take the 3-minute home loan quiz on my website. There's a specific path for self-employed buyers. I'll send you a personal response based on your actual situation, or reach out directly and we'll look at your bank statements together. I can usually tell within one conversation whether a bank statement loan works for you and what the numbers look like. This is one of the situations I work with every week. You're not a difficult case, you just need the right lender.